All right, it is just past, I think, 11 a.m. on Eastern time here. So let's go ahead and get started. Welcome to the December market outlook from Blockchain.com, entitled The End of the Transitory. We're going to be digging into a lot of different topics today, and we're very excited to be joined at the end of the presentation by Charlie McGarraugh, the Chief Strategy Officer and Head of Markets at Blockchain.com, for his insights into the markets. As usual, we'll be giving updates across what the team has been working on and some on-chain insights with the help of Dr. Garrett Heilman. So without further ado, let's go ahead and jump into this month. So welcome to the podcast. My name is Nicholas Carey. I'm the co-founder of Blockchain.com, the author of The Future is Decentralized, and the founding commissioner for the Blockchain Commission for Sustainable Development. So here at Blockchain.com, the team has been really busy, and I want to give you a quick update on some of the things we've been working on. We've had almost 80 million people sign up for Blockchain.com wallets in almost every country around the world. We're going to hit that benchmark maybe later today. So very exciting to see that growth in the user base. The past year has been the fastest growth across the company's 10-year history. Those users have conducted almost $1 trillion worth of on-chain transactions, and we're regularly seeing almost 60 million impressions to the Blockchain.com website, which is really sort of the beginning of the journey that many people start on when they explore cryptocurrencies and more. So talking a little bit about what Blockchain.com offers, really there are two sides of our house. There's the consumer offering, which is the first place that many crypto curious begin their journey by signing up for a Blockchain.com wallet. They're free. You can get one from the iOS, Android, or logging on to the website as well at Blockchain.com and start your first wallet. It's a great way to begin your journey. You can buy some crypto quickly with a credit card or linking up your bank account. We also have the Blockchain.com exchange, which is a little bit more of an advanced product for people that are trying to get more features, as well as trading pairs. The Blockchain.com Explorer continues to innovate and is a great place to see what's happening on with the cryptocurrency markets. And we also have a variety of partnerships that we're launching. On the institutional side, we have a complete offering, everything from institutional lending, over-the-counter trading. We have liquidity and execution capabilities. We are actively participating in decentralized finance markets, custody and asset management, and much more. So if you have any questions about that, you can visit our website to learn more about the institutional offering. We'd love to meet with you. So the team has been busy. Let's talk a bit about what we've shipped. So in the past month, we've launched a stable coin across the Eurozone called CeLO Euro. It's available inside the wallet in the exchange. And it's possible now to earn interest in euros, which is a very incredible feature for the folks in that market where they're seeing negative interest rates. We've also launched a much demanded feature called recurring buys. So if you're not sure how to time the market, one way to gain access to crypto is to set up a fire and forget system, buy a little bit every month. And that dollar cost averaging is a really great way to quickly and over time sort of build up a position in crypto. So definitely a great way to get started, especially if you're not super interested in doing day-to-day trading. The private key wallet now supports over 99% of all assets by market cap on the Ethereum network. So if you've been dabbling in ERC20 tokens across a variety of different exchanges or brokerages, you can now store all of those assets inside your Blockchain.com wallet. So those are now welcome within your wallet. We've also renamed the PAX digital dollar to USDP. So if you've seen that change, that's now live on the Blockchain.com wallet and exchange. And we've simplified our trading limits across all of our products to make that a little bit easier for people to understand. Okay, reminder, we got a couple things coming up. It's been a busy week here at Blockchain.com. We just announced the acquisition of Socio, making Blockchain.com the largest digital currency provider in Latin and South America. So bringing on over 100 headcount with that acquisition, and very excited to be welcoming that team. They've been working hard for years down in Argentina and have built out rails to make it easy for people in Latin and South America to buy their first crypto. So we'll be integrating that whole group and team and products into the Blockchain.com experience. Very excited to be working with that team over the long term. We also just launched an NFT Explorer. So if you haven't been paying attention, non-fungible tokens or digital collectibles or digital pieces of art are really all the rage. There's a huge conference happening in Florida this week called Art Basel. And I would say over 50% of all the projects here have some tie-in with cryptocurrency collectibles. So really interesting to see how that's coming along. The Blockchain.com Explorer was the first product we ever built, and we continue to innovate in that way to show people what's going on across the on-chain capabilities. And one of the ways of looking at what's happening is showing all the art that's being created now using digital technologies, including NFTs. So we are also launching the Blockchain.com NFT waitlist. This has been a much demanded feature. So very excited to showcase that. We'll literally be pushing that live any minute now. The team will be pushing a blog post out, but we'll be giving a special sneak preview to all the podcast listeners here today and viewers. So next slide over. If you visit blockchain.com /waitlist/NFT, you can sign up. We're going to be launching the ability for you to buy, sell, trade, and share your NFTs directly from your blockchain.com wallet. This is a really cool feature. You're basically going to have a gallery right within your wallet of all your favorite art that you've collected on the internet. So if you want to get access to that, please join the waitlist. There are now thousands and thousands of people that are signing up for this feature. We're really excited about it. Moving on, a couple other things coming up. Here's the NFT Explorer, so you can browse all the different online collections of different NFTs and see which ones are most popular. These are the reward rates for the month of December. So if you're holding on to stable coins, you continue to earn impressive rewards in the specific markets that are eligible for those, as well as all the different assets that we support within the Blockchain.com Wallets Rewards program. So if you want to earn some extra yield and have your crypto earn some funds for you while you sleep, definitely deposit those in the rewards feature. The Blockchain.com Exchange has recently launched an iOS and Android app. So if you've been using the web version, definitely test out the mobile version as well. We're launching new features for the Exchange app on a monthly and weekly basis. Definitely looking for feedback on how we can improve that experience for our community. And last but not least, we are hiring. So we have over 80 open positions. So if anyone is listening today or watching this overview, we would love to have you explore the different career opportunities here at Blockchain.com. Literally every single team across the company has open roles, and we'd love to see a resume and hear your enthusiasm for crypto and why you would want to help us build. So please check out blockchain.com/careers to see the different opportunities across the world to join our team. Okay, last time we spoke, we did a market outlook and discussed what was happening across the market. We also had the co-creator of CELO come talk to us, Dr. Marcus Frank. Really interesting conversation. You can find that online on YouTube, as well as in all your favorite streaming services if you want to visit what we discussed last month. Going forward, today's focus, we'll be going through on-chain insights with Dr. Garrick Heilman. And today's special guest is Charlie McGarraugh, the Chief Strategy Officer and Head of Markets at Blockchain.com. So stay tuned. We'll be interrogating him about what's happening. So without further ado, I'd like to welcome my colleague, Dr. Garrick Heilman, one of the foremost economists in the cryptocurrency and general market space these days. His contributions are regularly cited on CNBC, NPR, Fox News, Wall Street Journal, and many more. We're very lucky to have him join us today. Dr. Garrick Heilman.
Thanks, Nick. I'm not sure I've actually appeared on Fox News, by the way.
Oh,
but,
okay. All right, not yet then.
I'm still waiting for Tucker's invite.
Yeah, I can't believe they had Sailor go and not you. That was I thought that was silly.
No, thank you for the introduction, and we're gonna move quickly through this to get to our conversation with Charlie about markets. Very excited to hear his thoughts on the latest price action and kind of try to provide a preview of the year to come. But just briefly, the end of the transitory, which I'm sure we'll talk more with Charlie about, Fed Chairman Powell, who was renominated to head up the Fed, that's a big topic as well, suggested retiring this term transitory that the Fed has been using to describe the current inflationary environment. And so I'm sure we'll be talking more about what that means for inflation, what that means for crypto assets, in particular, Bitcoin as a hard asset. As we've talked about and blogged about, the virtual asset that ironically is the hardest asset in history. But briefly, when we look at the markets for November, we see a bit of divergence, and Bitcoin was down slightly for the month. Ethereum up 8% up for Ethereum, down a little over 7% for Bitcoin. And one of the themes that we're going to be asking Charlie about is kind of divergence among crypto asset performance, especially in the year to come. Are we going to see more fundamentals factored into how especially sophisticated investors are allocating across the crypto asset landscape? Is kind of the traction that in product market fit that Ethereum is seeing, especially around NFTs, which have just been hugely important to kind of crypto asset adoption this year. Are we going to start to see those fundamental factors play more into separating the real winners from the underperformers in the crypto space? But that's something I'm sure we'll talk more with Charlie about. Yeah, briefly in November, we saw bonds and the US dollar up slightly. the traditional markets, the S&P 500 down a bit, gold down, continuing to underperform. Just stunning, really. Maybe another thing that we'll pick Charlie's brain on as an ex-metals trader. Just what has happened to gold in the last 12 to 18 months with this inflationary environment, and gold lagging to drifting down. Is gold broken? Is Bitcoin responsible for kind of the death of gold as an inflation hedge, or is gold going to rise again? But we'll save that for a little bit later. Just briefly on chain, we saw a pickup in Bitcoin transactions and payments for the month. So even though price was down, we saw more fundamental use of on-chain space, which is positive. And Blockchain.com continues to represent about 25% of all Bitcoin transactions, and a little over 10% of all payments on the network. We've seen the hash rate also continue to rebound post the Chinese mining crackdown this spring, and is practically back to where it was pre-crackdown, which is positive from a network security perspective. The higher the hash rate in general, the more secure the network is. The more secure the network is, the more value people feel comfortable trusting to Bitcoin, and so on. So that's a very positive, healthy sign as well. Okay, without any further ado, our special guest, our very own Charlie McGarraugh, head of markets, head of strategy at Blockchain.com. Charlie, welcome to the podcast.
Hey guys, great to be here. Thanks for having me.
All right, so Charlie McGarraugh comes to us from a long and illustrious career from Goldman Sachs, where he was a partner. He was the head of metals trading, and then was a serial entrepreneur himself. We acquired Charlie's company a few years ago, and he's been at the helm of the markets group, among many other roles here at Blockchain.com. But I think one of the first questions I'd love to ask, you were a gold bug, and you traded gold for some of the largest institutions in the world. What is going on with gold in 2020? This is a market that we expect to see gold doing extraordinarily well, and then it's down. It's doing the exact opposite of what people would expect. Can you dig into maybe why that's happening?
Yeah, gold is like this. It's a bit like Bitcoin in the sense that it's like a Rorschach test of like your prior beliefs. Like it means different things to different people, and Bitcoin is really the only asset I've ever seen that is even more polarizing of opinions than gold. Back in traditional world, in some ways, gold is not a respectable thing to talk about with a big portion of the client base or the investor base overall. It means different things to different people. And so, to some people, it's a countryless currency. To other people, it's a default swap on sovereign risk. To other people, it is just the anti-dollar. To some people, it's just a commodity with a normal supply and demand, and you can just figure out the production on it, and that's kind of it. And then I think where I came out on it ultimately is it's like a bond. It's a bond that is guaranteed to pay you a 0% real yield forever. And that's and that relationship between real yields, in other words, how much the prevailing level of interest rates are less being adjusted for inflation. And as real yields go more negative, or as they go down, gold should be more attractive, because zero looks pretty good if treasuries minus inflation is actually a negative number like it is now. And so as real yields came down over time, gold rallied a lot. And this year it's been a little bit more kind of back and forth. And so this year we really saw growth expectations in the world going up on the rebound from COVID. And that has been a pretty big weight against gold. So even though there's some inflation that's coming from supply chain problems and stuff, that like generally it's in the context of a big uptake in global growth. And since gold represents basically the value of putting your capital in cold storage and not doing anything with it, when there's a lot of growth in the world, real yields should be higher. And so, why be in gold, basically? And that's why gold has traded poorly. I think it's really interesting because one of the predominant narratives on Bitcoin is Bitcoin's like gold, but more so, right? It's even more scarce. It's even harder to get, right? And it's it's even more useful, I guess, than gold because it's easy to move around really quickly, comparatively speaking to gold anyway. That narrative, I think, has kind of broken this year. because Bitcoin is digital gold, even though that's kind of the popular inflation narrative, kind of hedge narrative. Bitcoin's been trading pro-correlated with the equity market. Like, in other words, pro-correlated with growth. So like, is crypto a risky tech equity, or is it this kind of, antisocial, I'm going to kind of put my money away in cold storage and save it and not deploy it in the real world kind of thing? Feels like it's more like a risky tech equity. It's a speculation on how the world's going to go. And so I think the big uptick in post-COVID growth is really what's held gold back, basically, and benefited Bitcoin.
Yep, interesting. So last month, the consumer price index said that there was 6.1% inflation. Can you talk a little bit about whether or not that number is even remotely accurate? And we titled this presentation at the end of transitory, and maybe opine a little bit about this new era we're in, which is potentially permanent era of inflationary pressure.
Yeah, so this is a pretty deep topic where we could go miles deep, but let me just and it's frequently debated out there in the market. Let me just add a couple of thoughts which may hopefully add a little bit of value on the margin. First of all, regarding is 6% the right number? Is the CPI constructed honestly and correctly? I'm just going to punt on that. That one's radioactive. Everybody's got an opinion.
Boo.
Nobody's opinion is going to change. So we're going to leave that one for a second. But I do think it's really interesting when you think about the asset inflation that has predominated really since the end of the Euro crisis. Right, I view kind of the financial crisis all the way through the Euro crisis. You can see my little coffee mug here. I keep calling and blame the Euro, which my wife got me as a gift. But when you think about that whole kind of era of, oh, wow, the banking system's over leveraged, now we're going to backstop it and move that risk up to the sovereign, basically, right? Since then, we printed a lot of money, a lot. And that's created basically a huge amount of asset inflation and potentially crowded out real economic activity, because it's basically allowed businesses that are not viable to carry on financing themselves, basically. And so you could argue that all the asset inflation has actually been bad for real growth. I would probably feel pretty strongly in that camp. And with COVID, but you've had all this kind of financial leverage and this kind of war between the ever rising value of balance sheets and yet the sort of painful lack of growth in income statements that support those balance sheets, basically. But what's interesting is that with COVID, and that's all about financial leverage. With COVID, though, COVID really disrupted the operating leverage of the global economy. It's less a financial construct and more like we had just-in-time inventory and highly optimized manufacturing processes and a very long, very efficient, but very finely granulated and highly specified supply chain in lots and lots of different industries. With COVID coming and creating an operational disruption, financial tools like intervention from the central banks are not as effective in fixing something that's been physically in the real world of meat space and molecules actually being interrupted. And you saw that with oil going massively negative, during the COVID crisis, because there just wasn't any storage. And now the commodity inflation that predominated until quite recently, where the supply chain just isn't physically working because it's been disrupted a lot. And I think that supply side inflation, which really comes from an economy that has to readjust to shorter supply chains and more resiliency because there's just more uncertainty. And that supply side inflation is not really fixable with monetary policy, at least not as easily fixable with monetary policy. Of course, if they just keep hiking rates eventually and cutting the Fed's balance sheet, eventually they can create deflation, but only in the context of a massive hit to growth. And so when we look at how it's going now, I think there's a really big open question in the market, and it's driving a huge increase in risk premia around, is the existing policy toolkit effective medicine for what ails us. And I think the market is really kind of saying like, wow, on the one hand, we have this high inflation and the central banks need to react by basically taking action to reduce aggregate demand in the face of a reduction in aggregate supply to keep prices stable. But it's not necessarily, but the risk of a big policy mistake that tips the market over into recession is quite real. And I don't think there's any consensus in the market around whether the Fed is like way too lenient or not hawkish nearly enough. And that's fundamentally because monetary policy and the composition of the Fed's balance sheet is not the right tool to deal with what is a physical supply chain constraint. And so what the result of that is there's, you know, the market, I think, kind of ignored this for most of 2020 because we were just busy bouncing back from COVID and, you know, getting outside again. And most of 2021 as well. And then the assumption was sort of like, well, the fiscal deficit is so big, they've just got to keep digging the hole. You know, they can't, what can they really do anyway? But now that Jay Powell's been reappointed and they're kind of saying like, hey, we do need to do something, because the market has no, like, there's no obvious consensus on what the something that they need to do is. The fact that they're saying we're in play, we're watching, we're going to take action, but nobody can agree on what the action is just driving like a much higher degree of uncertainty and therefore a re-rating of risk all over the place. So I think that's kind of and I think that's likely to persist for quite some time, because these supply chain issues they're getting fixed, but they're not going to get fixed overnight. And it's not clear at all, especially now with the new COVID variant out there, what the appropriate response is to the existing situation. Yeah, so that's kind of the setup. And let me just opine for a second, sit in my armchair and have a personal opinion. I don't speak for Blockchain.com or anybody but myself on this. My own view is that they're likely more constrained than they're saying now, and they probably don't mind putting a little bit of fear into the market, because the more that the market basically synthetically hikes for them by re-rating risk premia, flattening the curve, and so forth, then the less they actually have to do. I think it's an open debate, though, how much they can actually do. And if the market just keeps rallying and really will stay super negative, I think then basically the market will be challenging them. So right now, the behavior that they've induced in the market, I think, is probably to their liking. At least it would be if I were the chairman of the Federal Reserve, which I'm not.
Yeah. One day, Charlie. One day, Charlie, you're going to get the nod. I foresee it. You know, there's a lot to unpack there. And this, like you said, this is a huge topic we could spend hours on. I think for the listeners, the term that the monetary policy tool in Jay Powell's toolkit that he and probably the other governors are going to be using a lot, which I think Charlie mentioned, is the jawboning tool, talking to the market, trying to scare the market, you know, with words. Sometimes trying to maybe encourage the market at other times. I mean, that seems like something we're going to see more of. I think we saw some of that this week. I think there's a real question in my mind, Charlie, and I'd be curious how much tolerance the Fed would have for some kind of major decline in asset prices and in this environment. I think for me, I'm deeply skeptical that the Fed's going to sit back and watch the markets tank 20%. And not, you know, come out and say something or do something, even just because things are fragile, as you discussed in the supply chain world, meat space world, but also in the asset price world, and all this uncertainty around new variants. And I feel like, you know, and that's going to buoy markets, that knowledge that maybe the Fed is tied, hands are tied, and they're not going to sit back and watch a 20% decline. I mean, what do you think about that?
Yeah, I think I take the other side of that, actually. I think they're probably more willing, because so many people have made so much money on asset appreciation in recent years, especially post-COVID. I think it's probably, and inequality is a big political issue. I think that there's probably is some tolerance for a re-rating lower. I also think that inflation has not been an issue until recently, but inflation is political, right? And you know, yes, wages going up is great for the great mass of voters, but living expenses not keeping pace with wages, or exceeding the pace of wage increases is definitely, you know, electoral kryptonite. And I actually think it wouldn't be surprising to see the Democrats become more hawkish on the margin, because inflation is actually a political issue for you know, middle and lower class America. And so I do think that there is some, and if, you know, the other thing I would say is, boy, the toolkit feels like an awfully blunt set of instruments to go and perform open heart surgery on the economy.
Mm-hmm.
I wouldn't be surprised if as the problems that need to be solved by policymakers get more complex, they might want a more finely granulated toolkit to deal with it. And that would come in the context of more finely granulated regulation to encourage and discourage certain kinds of activity. And also ultimately is a very strong argument for implementing a CBDC.
So I'm glad you brought that up.
A much more, a much more accurate tool. It's like more like a scalpel. Like you can basically engineer the behavior of the money depending on who's holding it, right?
Yeah.
So if you're a giant tech oligopoly sitting on billions of dollars and not deploying them in the economy, maybe you get a negative rate, right? And if you're, a small business owner in a swing state, like maybe your dollars earn 10%, right? And they could totally program that if they had a digital dollar. And I suspect that fact is not lost on them.
So yeah, Charlie laying out his ideas for his future candidacy for Fed chair right now as we speak here. But on the CBDC note, I'm so glad you brought that up. We had big news this week. David Marcus leaving what's it called now? DM / Novi. I mean, they've been playing this name changing game there. You lose track of it all. We had, questions around what Lael Brainard's appointment might mean for kind of the CBDC debate against, Jay Powell and others who've kind of come out and kind of signaled some support for the idea of maybe the Fed shouldn't do CBDC and actually should just kind of lean on the private sector and private sector stablecoins to be synthetic CBDC, with the Fed playing a more active role in managing those stablecoins. You're making a great point, though, I think, about how the CBDC is a scalpel for not just performing monetary policy, but also just efficiency, right? I mean, the billions that the US spends each year on minting coins and banknotes, the inefficiency around the COVID payments, lost checks, the delays. I mean, there's a lot of arguments in favor of digitizing payments and cash in general. And you're making the case that basically the macro setup also is a further argument. So what's your kind of view on the timing of CBDC and what that might look like specifically in the US, where I think there's more question around what this thing is going to look like, more political debate?
I think it will take time because everything in America that touches on politics is complicated, to say the least. And governance of the banking system in America is fractionated across lots of different regulatory stakeholders, in addition to a whole lot of vested interests. So I do think it will take time. Necessity is the mother of invention. I think the question is really, does the need for a more finely granulated policy toolkit, manifest itself more aggressively? Because that has a way of clarifying consensus building. I suspect not. I suspect it will take still 3 to 5 years at least. That said, I think there's quite a lot of pressure to advance the conversation further than it's come because of what the Chinese are doing, and also because of the threat of private currencies from tech platforms, right? And I think it's quite interesting when you see the big incumbent banks, they're starting to get a lot more tech fashion forward as well. Goldman announced a cloud offering, I think, yesterday. So open for debate, but I think the pace will accelerate, but it'll still take a while.
Interesting. If we could turn now to the crypto markets, and one of the topics that I teed up in the market section about kind of divergence, our boss, our CEO, our co-founder with Nick of Blockchain.com, Peter Smith, is on record saying that he thinks for 2022 we're going to start to see more divergence, and it's not going to be as easy just to make money spraying and praying your allocation across the entire crypto asset sector. You're going to need to be more selective, and the way I interpret that is fundamentals are going to start to matter more than they have, and I'm just curious, where do you come down on that debate? I mean, we saw Ethereum diverge from Bitcoin in November. It's up over 500% for the year. Bitcoin's up 100%. What's your view?
So there's a lot of different factors at play here, in my opinion. One factor that's at play is the pace of innovation in the space is accelerating. And there's been a lot of capital inflow into the space to fund additional innovation. Lots of venture rounds being printed, lots of new projects, a lot of interesting stuff. And the infrastructure layers for the whole space are better and more performant. One of our product managers here at Blockchain.com told me recently how excited he was about the development of scaling solutions for Ethereum, because he's like, look, with layer 2 actually working now, it's great to feel young in crypto again, because we can build all the things that we couldn't build 5 years ago because the infrastructure can support it. And I thought that's really interesting. So there will be a lot more data points around how use cases are being kind of explored, iterated through, and some of them will take hold and catch fire the way some of the gaming and NFT stuff did earlier this year. So that's kind of one piece of the puzzle. The second piece of the puzzle, so just ongoing acceleration of investment and innovation, basically. The second piece of the puzzle, though, is really about inflows. If lots and lots of new crypto investments are spinning up, they need product to buy. And so if there's not enough good stuff to buy, people still need to buy stuff to get their allocations put to work. So, and there's an element of a self-fulfilling prophecy there too, because obviously if a project is better funded, it has a higher chance of becoming successful. But I think as long as the pace of investment inflows from traditional world try to cross the bridge into the crypto ecosystem, that is likely to fuel more stuff and keep the correlation somewhat high between assets. And then I think the biggest piece of the puzzle actually is on the macro side. And it's more about the level of real yields, right? So when real yields are negative, money in the distant future is worth more than money today, which means that the stories that you tell are not particularly accountable to any observable data point of how they're actually going right now in the present, right? So to the extent that real yields go up, the market will care a lot more about spot current observations of how things are going and less about the stories that people tell into the distant future. Now, probably a much higher real yield in that sense is bad for all of crypto from a price perspective, because crypto is all about a story of the transformation of the internet over a decades-long time frame. By the way, a story I believe, and I think there's a massive amount there. But from a pricing perspective, the higher interest rates go and the higher real yields in particular go, the more accountable everything is to how is it doing right now, not how will it do in the distant future. And so in that sense, higher real yield will definitely lead to a lot of differentiation between project quality, because the market's just going to care a lot more about the short term than the long term. Now, that said, I think there's some incredibly high quality things here in the space. I'm going to refrain from naming names just because I don't want to put our company in a position of, sponsoring something without the appropriate consensus built in the company. But in my opinion, there's a lot of very interesting projects that are having a lot of real traction and a lot of real success. And it is surprising to see how little differentiation the market puts in that versus other stuff. And
I think one of the big headlines is basically like it's just going to get more competitive, and that will cause some winners and losers to differentiate themselves. There's a couple other factors that I think are worth mentioning. So the sort of three macro trends are obviously the inflationary environment that we're all existing in and trying to navigate that. The institutional investment into crypto is actually happening this time, unlike in 2017.
Sure.
And then you really do have this cultural zeitgeist of all the creators, the authors, the musicians, the artists are actually working on ways to have more ownership over the things that we entertain ourselves with using Web3 technologies and these layer 2 scaling capabilities on things like the Ethereum protocol and even Bitcoin today. So any one of those factors, I think, would have been a relatively bullish, macro trend for crypto in general. But all three of them are happening simultaneously.
Nick, I'd actually add a fourth factor to that, which is broadly defined global.gov, how they're thinking about responding to all of this. Right. The regulatory environment kind of at the all over the world and how it interplays across jurisdictions. And what I would say is crypto is now too big to ignore. And so frameworks are going to have to evolve. And I think there's a tendency in the market to kind of view that as, ooh, they're going to kill openness and innovation, and they're defending the banking oligopoly, which is really interchangeable with the government actually, and there's a whole bunch of incumbent interests that don't want to see crypto succeed, and kind of all this paranoia, right? There's of course a kernel of truth in some of that, but there's also a lot of very legitimate concerns that are being raised, and now that crypto is big enough to matter, those concerns have to be addressed. Consumer protection, crime prevention, anti-terrorist financing, anti-money laundering. These are important things, right? And I don't think anybody in good faith can kind of question the premise of that stuff. And it's going to have to get worked through. And the market tends to see these regulatory headlines as very negative. But I would actually take the opposite view, which is like, to the extent that clarification can occur, it just opens up the accessibility of the market to far, far greater pools of capital, far, far larger segments of the population overall, and legitimizes the whole asset class. And will ultimately allow the innovation to occur at far greater scale.
That market access point is a big one. I mean, 2 weeks ago in Lisbon, there's this huge conference called Web Summit, sort of the largest celebration of technology companies that are building things for the internet. And there's 50,000 people that attend this thing. I walked through the floor. Every single financial technology company was either immediately tooling a crypto offering or was planning to integrate some type of crypto on-ramp or feature set in 2022. So I think as we gaze into the next year, I might put Garrick on the spot and have you maybe opine a little bit about some of the things that you're working on. You made some famous predictions at the end of last year, including that crypto would reach $1 trillion market cap over the next couple of years. Now you're a little bit off on the timing, but you were absolutely right on the direction. What are some things that you can preview for us, heading into the end of this year, reflecting on what's happened in the capacity and scaffolding that's been put in place? Where does 2022 potentially take us?
Well, Nick, you're really putting me on the spot here, because I have not come up with any kind of 2022 predictions yet. I mean, the one I'm happiest with from last year, my big prediction was that we'd start to see sovereigns adopt crypto assets, Bitcoin specifically. Did not see El Salvador coming specifically, and their move to even leapfrog what I thought would be a first step, which would be sovereign wealth funds, taking more open public positions in something like Bitcoin. We actually saw El Salvador adopt it as legal tender before then, announcing they were going to be buying it and holding it as a reserve asset, which they've done with increasing quantity. So for 2022, I'm glad Charlie brought up the regulatory question. It is the boogeyman. It is the cloud that hangs over this space for many people. But I think, as Charlie correctly says, and this has been true from the beginning, going all the way back to 2013 and FinCEN's original guidance, the clarity has been net bullish for crypto. And every time a regulator comes out, sometimes they may go too far, get something wrong. The New York Bit license was very famously kind of poo-pooed as being too expensive, too cumbersome, et cetera, et cetera. That may be the case, but these things have been broadly bullish. And I think we're going to see more clarity. We saw even further clarity this week from Janet Yellen talking about FATF's recommendations on non-custodial wallets, something that's very relevant, of course, for Blockchain.com. Again, removing some uncertainty around what's the Treasury's view on this. So all of this, I think, is really good. We're going to see more, I think, debate, though, over topics that are going to be tricky for the industry to navigate. And I would highlight, I think tax is a big one. And tax is something that's coming, and it is where the rubber meets the road on kind of crypto asset industry flexibility and compliance, and stuff that maybe the industry is not going to be excited about. And I'm talking specifically about pressure on DeFi to integrate automated tax compliance into the protocol or into apps, and that's something I don't think people are really thinking about. It's very complicated, very controversial, but the bottom line is this: you cannot have a functioning society, all right, without a fair tax regime, period, full stop. Society breaks down, and that's something that we all cannot tolerate. So how that all gets worked out, whether 2022 is the year it starts to get put on the front burner for discussion, I don't know. Come check in with me at the end of this month. But there's a lot on the regulatory front that I think is going to be front and center next year. And I think on the whole, that is good. It kind of helps facilitate in Greece this transition to Web3 and the crypto Wall Street convergence theme that we've been talking about for years. That is finally playing out.
So the relationship status is it's complicated. I got it.
It's complicated.
So we can look forward to. So we
Charlie,
look forward
what do you have to say on that?
I think that, to the extent that tax compliance can be automated, that's a great thing. Like, I don't think people question the premise, should they pay their taxes? It's just complicated to operationally figure it out, given the complexity of all the stuff in the space. And so I think it's an incredible business opportunity to just make that easier. And there's a number of platforms working on that, and that's great. And very pro-social, right? And that's an important theme too, I think, which is crypto should be pro-social. It's all about, breaking down barriers between people and helping people to do things better, faster, cheaper, safer. And a pro-social message, like, I can definitely get on board with that. And I'm sure I speak for all of Blockchain.com on that sense. And now in terms of the outlook for the market, which probably some of you are waiting for, I guess my view is that the derivatives open interest is still very large in our space, but it has been shockingly resilient to movements in the funding basis, which is a very different behavior in the market than we've seen earlier this year. And I think that speaks to the fact that it's getting more accessible constantly to access balance sheet, and more traditional players are able to finance crypto positions. So I think, like, the biggest thing for next year will just be the hunt for yield globally continues to find its way into financing crypto. And so I expect a lot more growth in our lending business. You have, $2 or $3 trillion of market cap, and I don't know, maybe $100 billion total of financing against it. So there's just a lot more work to be done there. And I think that will continue to drive institutional adoption in the space, just kind of the hunt for yield. And the ongoing professionalization of the crypto industry's backward compatibility to the street, and the street basically making the push to forward integrate to being able to access crypto world. And I think they have to, because they run a pretty meaningful disruption risk if they don't get their act together. And I don't think that's lost on a lot of institutional world now. So I think that'll be a big thing. So I would imagine volatility continues to come down over the course of the year. Subject to some more clarity on the central bank policy pathway, but I would imagine we get that over the next couple months. I think that the end of year dynamics will be pretty interesting into Deck 31 here, around how much more end of year motivated, locking in gains, locking in losses, just all that kind of thing. I just expect the market to kind of chop. And then come the turn of the year, I would imagine there's pretty big January effect, ongoing allocation. There's just been so much money raised in this space, and that money has not been put to work yet. And so I think we're still in a big uptrend. And that is also, first and foremost, fueled by the innovation, because people wouldn't be allocating the space if the innovation weren't here, and it is here. And so more innovation, we're still in kind of a secular bull trend as the technology gains maturity. I think volatility comes down, and if the dollar is a lot stronger and policy is a lot more hawkish, that will be a headwind for the market to face against. But what's more likely is they talk it hawkish with the jawbone tool, and then maybe actually stay pretty lenient actually, and the bull trend continues. That's kind of our baseline view.
Charlie, if we have time, I've got one more for you, which is, we've talked a lot about the US on this call. I'm sure a number of our customers, people out there in countries like Turkey, Lebanon, et cetera, very, very, very unstable situations, very scary situations, frankly. And I just wondered if you could kind of, you look out across the world and see things like what's happening in Turkey and other markets, and worry, how much is the market mispricing kind of like, societal collapse or really severe breakdowns in very large countries like a Turkey? And what does that mean for markets in crypto if that were to kind of go further?
Well, I think, again, crypto is accessible in many places in the world and is more useful than local currencies. You can't really make the argument that crypto is less volatile. because it's still quite volatile, at least in dollar terms. But I think systems that are atomized and resilient and less susceptible to one particular person breaking everything, will continue to do well. So I think those kinds of pressures, do present a tailwind to crypto. And certainly, our client base, which is heavily non-US, we talk a lot about US policy because it drives the markets, because the dollar is the reserve currency of the whole market, right? And stable coins, by the way, are just, increasing dollar adoption around the world, right? You're making dollar as the reserve currency more accessible to huge segments that previously didn't have it. So the policymakers should be delighted with stable coin utilization offshore, actually, if they really think about it, because it just strengthens the dollar ultimately. I think that's a tailwind. And we are very focused on serving those users. Obviously, our big push into LATAM is part of that as well. Just giving people a resilient exit capability. We think that's, again, a very pro-social mission.
Thank you, Garrick and Charlie. Amazing conversation today. So I think there are a couple of concluding things I just wanted to revisit. A couple other stories in the news this last week. 3 new multi-billion-dollar venture funds have formed with a complete focus specifically just on crypto that haven't even started to allocate yet. So there's still a significant amount of firepower to be deployed by risk takers there. Jack Dorsey has stepped down from being the CEO of Twitter to focus almost comprehensively on making Bitcoin the currency for the world, which is, I think, a non-trivial thing for him to be spending his time on. David Marcus, who was one of the right-hand men of Mark Zuckerberg at Facebook, also stepping down, who's had a long history of crypto interest. So we'll be very curious to see where he decides to go spend his time. So those are some big headwinds, I think, also pushing things into the end of the year. So as we reflect on 2021, I mean, it certainly was one for the economic history books. I think economists will be researching and writing about the phenomena of crypto, and a great focus will be on the past 12 months. So, without further ado, on the blockchain.com side, keep an eye on announcements related to new asset listings for the blockchain.com exchange and wallet coming soon. And if you have any interest in the NFT craze, we'd love to have you register that interest at blockchain.com, waitlist/NFTs. We'll be making an announcement on our blog momentarily, and keep an eye out for some exciting innovations, holding on to all your collectibles, digital art, and more inside your blockchain.com wallet. So thanks for everyone for tuning in. A couple last points to make. If you missed any of this, you will be able to find it on YouTube, on Facebook, and we'll also be publishing it on all of your favorite podcast streaming services. So let us know if you're looking for anything new. Send us comments on our social channels. We'd love to hear from you. Thank you very much for joining us for the December Market Outlook. Cheers.